Welcome to the latest Global Corporate Venturing webinar. I'm delighted to introduce the World of Corporate Venturing Guide. My name's James Mawson, founder and editor-in-chief of Global Corporate Venturing and also CEO. And I'm delighted to be able to run through some of the highlights from the World of Corporate Venturing 2022. Delighted to also thanks, obviously, Kalyan and Raksha for provided most of the data and contents and layout for that. Particular thanks to them. They've done a real superstar journey. It should be available to purchase or for GCV subscribers to download at globalventuring.com. And this webinar, this session for the next few minutes, will be talking about how CVC or corporate venture capital is transforming, a review of the pandemic and an outlook on some of the challenges and some of the opportunities that the industry ahead will face. So a quick summary of what we'll be talking about through the data, some of the analysis that's come out of the world of corporate venturing, is that we've seen a record year for CVC. That's pretty much on almost every metric: deals, exits, fundraising, and the rest. But there are a number of challenges that this growth has brought and are likely to bring, such as, in particular, the growth of new entrants or more unprofessional conduct from firms, increasing competition, and the challenge of, as the overall venture industry continues to grow and scale, being able to tap into the right network. In effect, there is a power law behind venture, and in particular, finding the right entrepreneurs to back and the right syndicates to work with can really make a difference between success and less good outcomes. And finally, whether it's now time to shift the paradigm and think more broadly and holistically about the industry. So a little bit of context about us. Obviously, Global Corporate Venturing, we've been around for more than a dozen years or so now, and we think about three things. We think about providing the right information and insights to help that direction travel, and obviously accessing the right community, whether they're co-investors or entrepreneurs, and working with the right syndicates. A review of ourselves over the past few years. Many of us think of us as a sort of trade paper, but we do a lot more than that. We obviously do a lot of magazines, reports, and daily news from the team. We do these types of webinars and digital forums, and increasingly more coming back post-pandemic into in real life events, whether in California, London, Tokyo, or Sao Paulo, and obviously a host of countries and smaller dinners and sessions elsewhere. We increase as a membership organization. It's very much think of us like a trade association in some ways, where we pull the community together and think about issues that will help us all. So I'm delighted to say that we've relaunched the website, and in particular over the past year, we've launched the GCV Institute, which is the professional development and training, not just for corporate venture capitalists, but the business development and C-suite and people within the corporations who need to land that value back of what the work of the CVCs are doing back inside the parent companies. So I'll talk a little bit more of that later on. Obviously, we're delighted last fall or in the autumn to have gone back to some in real life events. This is the event we did around the GCV Symposium in London in November around COP26, where we had a dinner inside St. Paul's Cathedral. We're delighted to take a delegation up to Cambridge and the Cambridge University and dinner in Queen's College. And we did a similar event in California in Monterey, again socially distanced doors. On the session today and tomorrow, we have the Rising Stars and Emerging Leaders Awards, but we do have a huge scope of corporate ventures and those interested in the ecosystem. A handful of those are on the screen, as you can see now. So thank you to you all for being able to join, and in particular, thank you for being able to engage so much with GCV and our other sister publications, Global University Venturing and Global Impact Venturing, over the past few years through the pandemic. We really appreciate the support. And also, I particularly want to note the advisors that through the Leadership Society, which is the membership organization, help us steer the right direction to help you all and us all as an ecosystem. So particular thanks to the new advisors joining the Leadership Society Advisory Board. We had a meeting last night on that. George Kellerman from Woven, Chris Lindener from Airbus Scale, Taxeto from MS&AD, and Nicolas Savage from TDK Ventures, and they join others that cover the range of geographies and sectors that we all are involved and engaged in as an economy and as a society. So thank you to you all. I particularly also want to thank the incoming chairman, Jacqueline Lesage from Munich Re Ventures. She replaces Young Sun, who finished his 2-year term from Samsung and has now set up a new VC firm called Walden Catalyst. So thanks, Young, and in particular, welcome, Jacqueline. Appreciate your support on the advisory board over the past few years, and particularly excited around the vision you were talking about yesterday about how the ecosystems can start to develop and continue to professionalize as an asset management industry. And you'll hear more from Jacqueline at the GCVI Summit and Symposium in May and June. So I don't want to sort of dive down too much on this slide here, but fundamentally what this infographic is trying to do is just show basically how impressive last year was, a record on almost all metrics, whether it's deals, exits, how corporates think about themselves, the loss rates, the fundraising, the global activity. Pretty much every country, every area, was a record. And we'll dive down now into some of the more specific highlights on that front. And I think probably the first place to start is this idea that if you take the clock back to 2010, 2011, when we were just starting global corporate venturing, there was only, relatively speaking, a few hundred active CVCs. In effect, corporate venturing still had a reputation among many as, in effect, dumb money and also a pro-cyclical asset, where it was the last to join in the economic cycle and the first to leave. And that reputation had been built up over prior decades, but particularly around the dot-com boom and bust, around the turn of the millennium, when a lot of corporates had started in 1999 and 2000 doing venture investing, particularly for financial returns. And then when the downturn hit in 2001, they immediately pulled out and sort of left a lot of entrepreneurs struggling. And also lost a lot of money because they kind of sold off a lot of their portfolio companies or just wrote them off, and it was a bit of a storm. And so the next 10 years in many ways was about that recovery and rebuilding. But now over the past 10 years, what we've seen is that almost exponential 20-fold growth in a number of corporates that have done at least one minority direct investment. Now, corporate venturing covers a wider piece, but we look at in particular sort of the direct investments that they make, minority equity investments in private companies, as well as the limited partner commitments that they make to VC firms that then go on to take those stakes. That fits with the wider piece around incubators and venture building, and also dealing with accelerators, and fits with the broader innovation toolset around M&A and R&D. And I think what many of the sort of more strategic as well as the financial together investors, the corporates are thinking about is this idea that actually, if you do venture investing well, you get a foothold in companies that can be exponential in growth. And so we're seeing corporations realize that disruption is affecting their core businesses, but it's creating a lot of opportunities that if they understand and get a foothold in, could actually drive their own business to higher heights. And so that idea that actually your downside is relatively limited, you only lose effectively the money that you're putting out, but your upside could be substantially more. So if you just take Ford or Amazon, their results earlier this month in February, they announced effectively more than 8 billion of profits, on their quarterly results, just from one of their investments in Rivian, which is an electric truck. And we're seeing a lot of corporates starting to see these types of returns and performance start to drive strategic opportunities as well as obviously financial. But obviously this comes at a potential issue as well. That's the level of rapid and fast growth, and we'll come to that soon. But again, just staying on some of the highlights from the past year. Obviously, we've seen as there are more corporates come in and more corporates get more comfortable and put more money out, this is really driving the amount of deals that they're able to back. So we saw more than 5,000 deals backed by a corporate, which in aggregate raised nearly $300 billion. That's more than double the amount in 2020, which was in 2019, which were the previous high points, alongside 2018 as well. So it's just a phenomenal year in terms of the investments across almost all sectors, did particularly well. And we also saw, and what was particularly, I think, heartening, particularly for many of the CFOs, is we saw money coming back, that longer term investments that had been made over the prior decade were really being driven by, obviously, take privates, M&A, and also the sort of SPACs and IPOs on that side of things. So it was a particularly stellar year, nearly more than 200 billion returned to the venture syndicates, of which include at least one corporate. And also we've seen a number of these new initiatives of corporates backing newer VC funds and helping them get off the ground. In effect, corporate venture capital isn't just, set up a team, they do some deals and then we'll see. It's also about understanding how, by engaging with other VC funds, you can tap into new regions or new sectors, learn and get some eyes and ears insights, as well as potentially financial returns as well. And I think one of the things that, again, points not just to the exits being important from a financial point of view, but driving some strategic value in terms of doing corporate venture capital well, is that we started to see the parent companies of corporates that do CVC well actually start to deliver outperformance in terms of their share price and overall returns back to shareholders. So we've just published our second book, Transformative Innovation. I'm delighted to have co-authored it with Christine Kilbranson, who many will know as the ex-CEO of Sergey Brin, the founder of Google's family office. She also was the Chief Innovation Officer at the University of California System and a serial entrepreneur and VC. And delighted to have learned so much while writing the book with her about the insights into California and the ecosystems more globally, what's been happening. So the book's now out, published. You can go to transformativeinnovationbook.com or just pick it up on Amazon. And attendees at the GCVI Summit in California and GCV Symposium will also receive a copy. So delighted to have published that. But one of the insights that we found by researching the book was that 71% of the Fortune 100 now have a CVC unit, up from about 10 in 2000 after the dot-com bubble. But the turnover has been high. And when you look at the turnover within the top 100 companies on the US markets, that actually, of the nearly half that have left, almost all didn't have a CVC unit during that time. And most of those that remained had or set up a CVC unit in that interim 20-year period. And interestingly enough, almost all of the new entrants into the Fortune 100 also had a CVC unit. So there's a very strong correlation between corporates that do venture invest in as part of an innovation toolset well, and their outperformance and likelihood of survival. And that kind of makes sense intuitively. You do go back to sort of the basic economics, what drives the revenue, what drives your performance, and is very much built around three things: human capital, physical capital, and innovation, particularly around intangibles. And so if you can get the innovation piece right, then you're likely to drive the top line and hence the bottom line and your margins. And that's likely to then drive the share price, because obviously that's just a bet on future earnings and future income. Whereas the companies that fundamentally try and reward current shareholders by perhaps borrowing money to give more money back in netting as shared dividends and buybacks, are likely to underinvest in their future earning potential and hence see longer term sort of underperformance in terms of relative to their peers. So I think there's a strong sort of theoretical basis behind why we're seeing it. And now, after the past 20 years, particularly the past 10 years, really starting to see the numbers stack up to support that theoretical basis. So I think that's really exciting. And some work done by Touchdown Ventures in terms of analysis, they looked at the GCV Power List, the sort of top 100 firms that we see. We use a number of quantitative and qualitative metrics for deciding the Power List, which are awarded just before the GCV Symposium in May. And they found, when they compared to the market index, those with a CVC unit massively outperform the index, depending on when they were set up or when they were listed with a CVC unit. And so it's quite stark when you look at the numbers. And again, that kind of intuitively makes sense when you look at the components of the top 100 indexes, whether in the UK or the US. But I suppose with all this good news, I think there's also an issue that can be started, that come with that good news around some of the challenges that we're seeing. And we really have identified, I think, 3 things that are causing somewhat of concern. One is that, there's a degree of unprofessional conduct that's either happening or would be incipient given the number of new players that are coming in, which could cause issues for the industry as a whole. Second, obviously, the overall venture industry is bigger than just corporate ventures, and we're seeing new competition and more competition for deals increasing. And that thing, again, puts pressure on those to tap the right networks. How do you find the good partners? How do you develop your thesis? How do you find those entrepreneurs and really add value back to the entrepreneurs? Really, an entrepreneur, she's looking for 5 things. She wants capital, customers, product development, hiring, and an exit. And understanding how you can pull together a syndicate to add value, maybe and complement each other, is really important. And the stats are very clear that a sort of a mixed syndicate bringing together different attributes can really help the entrepreneur, can really help her drive future value. And this comes back to some of the issues around educating the bosses. I think one of the things that I mentioned before about setting up the GCV Institute, it came out of work that we did with the prior book, Corporate Venture and the Survival Guide, with our colleagues Liz Arrington and Heidi Mason at the consultancy firm BMG. Liz now runs the GCV Institute, so it's been a fantastic partnership, bringing the methodology that they have understand around the maturation cycle alongside the data and insights from the community through the surveys and other things that GCV does. But that institute is effectively being able to power corporate ventures by CVCs, for CVCs, the main leadership society, spend time giving back, helping us develop the methodologies and the tools. They also mentor and provide the feedback and enable not just the CVCs who are trying to develop their skills or talk to each other or new into the industry, but particularly around the business development and the C-suite who really want to know how to use this tool most effectively and land that value back in the parent company. And so I think one of the things that we found is that, again, working with Stanford University, Ilya Strebilev and Amanda Wang, they did some research looking particularly at the Fortune 100 list, Fortune 500, and they found that 60% of the CVCs that they talked to, Ilya and Amanda talked to, had said that their parent companies do not understand the norms of venture capital. So it's really important not just to understand how to do the job well and engage with the entrepreneurs and do all those right things, but at least half the job, often for many of the CVC leaders, is talking to and communicating with the parent company and the managers so that they can understand what's going on. And as obviously this management change and upheaval, that's a continuous process. So the GCV Institute has been set up by CVCs partly to help themselves get trained within their team, but particularly to deal with that issue around education and bringing that knowledge back inside around the benchmarking and being able to say, this is why we're good, this is why we do what we do in the way that we do it, and bringing that knowledge in is a relatively efficient and effective tool. So more than, and as I say, about half the 200 plus corporate attendees to courses last year came from those learning how to land the value of CVC inside their organization. And we're also setting up, thanks to Jana Ruther joining us earlier this year, we're also setting up the GCV benchmark, which will enable corporates to better frame how they're doing to their sort of parent companies and ultimately eventually externally as well. So thank you very much to Jana and Liz for being able to drive so much in that. This goes back to the issue, obviously, of 2 challenges. One, we see a lot of new corporates coming into the ecosystem, particularly through the pandemic, but also the more established corporates, again, through management change or just personnel change or just change in strategy, are struggling to develop the longevity. Even quite well-established corporates, receive management change, and again, they lose their teams. We've written a number of articles about some of those upheavals, and it puts pressure on the remaining people, but also causes concern among established venture syndicates and the entrepreneurs, because they get used to working with a specific person at the CVC, and when that person goes for whatever reason, it causes uncertainty. And we've just delighted to have worked with Claudia Van Muntz, who's Chairwoman Emeritus at the Leadership Society Advisory Board. She helped found the Leadership Society when she was head of IBM Ventures. She's now lecturer and teaching at Stanford. And we did a case study she presented of Nagraj Kashyap, who moved from Microsoft M12 to SoftBank, and a deal he had backed called Workboard with Deirdre Packnett. And they talked about how they did it. Deirdre was very clear, the reason why she offered the lead to Nagraj when he was at SoftBank, having left from M12, which was backed, was because she had so much invested in Nagraj and thought he was excellent. And so, it's very clear that that strong relationship is important. And so this level of turnover causes issue to the wider entrepreneurs and the wider VCs and other investors about how reliable will be, even if there's more than 500 corporates with more than a 10-year track record, there's still that uncertainty in the ecosystem. And this is some work that Nicolas Savage from TBK Ventures sort of was interested in, and wrote a great article called "Tossing New CVCs, a Life Preserver," which you can find on Medium. But he says, as competition has increased since the COVID-19 pandemic, new CVCs have less margin for error. GC3, through its Institute of Number Services, serves as a lighthouse, especially equipped to illuminate the path for these newly christened CVC ships, guiding them along the rugged coastline against which many unwary corporate ventures have been dashed, end quote. And the reason he mentions this is when you look at the pandemic since basically April 2020 to the end of last year, and you look at who was doing deals, about half, a little bit more than half, or nearly 1,900 corporates were doing their first deal in that sort of 20-month period, which is phenomenal. There was this almost equal number, but slightly less, that had been experienced and again used this. And why are we seeing it? Why are we seeing so many first timers use the pandemic? And partly it's because their core businesses were being disrupted, often affected by the pandemic. They had to think about digitalization. They were interested in things which perhaps have been more offline, sort of in real life work practices. Suddenly they had to find tools that could help them, and that sparked them to look at other areas or industries that could support their work. And equally, that sort of idea that software or other technologies are eating the world has really taken hold. And so that if you haven't been doing it, it's been very clear that you've been missing out on an important trick and tactic. So what does that mean in essence? As I say, the sort of that earlier stat about 20-fold increase broadly in active corporate investors over the past 10 or so years, it's actually made up when you look year by year. Not all corporates that have invested invest every year. And that points to either they don't have an established team, they don't have a committed capital base, they have management change. There's a whole host of different factors that can effectively cut them off at the knees. Even before their performance is then judged over that 5, 10 or longer period, so that people can actually judge whether they were able to deliver strategic and or financial performance. And ideally both. You have to at least return money in order to be financially self-standing, but you also need to be able to deliver things to the business units and parent companies shorter and longer term as well. And it's a very difficult thing to do. It's certainly one of the harder roles and responsibilities in asset management or just in business development and as an executive. So hats off to all of you within the corporate venturing community for being able to do this and really hopefully make the world a better place in that regard. But that issue of lack of consistency still is one that could potentially come back and haunt the industry as we look ahead and come out of the pandemic. So if you break down some of those numbers quarter by quarter, obviously through 2020 and then 2021, each quarter effectively saw more new units start doing venture investing, compared to even while some of the more established firms were still trying to do more deals as well. So it was a particularly interesting period. It feels like we might have sort of crested that wave. Be interesting to look at Q1 numbers, whether we'll still see so many, but even in Q4, 194 was effectively more first time corporates coming in doing their first deal than almost any quarter before, apart from Q2 and Q3 last year. Now, what does that mean? If you look back pre-pandemic in terms of corporates coming in, starting to do investing, getting confident, doing more deals, putting more money out, seeing the value that could be derived, corporates were very much why we saw in the 2010s the venture industry raise and invest more money than in all prior decades combined. So in that sort of 2010 period, by PitchBook data, there was about $1.4 trillion invested in venture deals, and corporations were involved in more than 50% of that by value. Now, that's a lot, and that sort of increase of capital, corporates have about $20 trillion of cash sitting on their balance sheet, could really help scale up the industry and help drive a lot more money to create more transformative change. It's very much a sort of a circle in that way. As more startups get more funding, they're able to do more things, that creates more disruption, which causes more corporates to think about having to do more venture investing to keep up with the change in the turnover. But that competition is starting to increase. If you look by deal volume, again, PitchBook for the overall venture data and GCV analytics for the corporate venture data, you see that while corporates obviously are doing many more deals, six-fold increase over the 10-year period, there was not quite the same percentage increase or fold increase, multiple increase by numbers of deals, nearly a four-fold increase by number of deals that the venture industry had done. But obviously that sort of relatively large number to start with means that there's been a much more increase in the number of venture deals out there than even corporates are able to bank. Corporates just fundamentally are providing more capital to help scale up the ecosystem rather than necessarily really increasing in terms of the number of deals they're doing. But ultimately that is one risk and one concern, is that competition is starting to increase. Again, if you look at the overall sort of percentages, what you start to see, even if you look at the percentage of total venture capital dollars, we're starting from a high watermark of nearly 2/3 of deals having corporates involved in 2017. We're starting to see that percentage start to fall. It's been down 16 percentage points over the past 4 to 5 years. And so while still substantial, it is less by dollars as well as less by volume of deals done. And I think this points back, if we run what we call a sort of power index, which is a quantitative algorithm that we use, which looks at corporates by their sort of deals and exits, and then it tries to come up with a sort of an index or ranking of who's been doing well. And then when you look at that sort of ranking, who likes investing with whom, you start to find groups like Fidelity, like co-investing with BlackRock in particular. SoftBank obviously likes working with sort of Tiger and Sequoia, and you start to see really interesting analysis of different groups forming very strong partnerships in different ways across different sectors. And that obviously depends sector and region by region, but you start to see some overall trends. Some groups just never co-invest with others, and you wonder why, and you just think it comes down to a lot of the personalities. They just not find deals or find opportunities to connect with each other. But I think from a general point of view, understanding the sort of that heat map of who's good, how you work with them, rather than just being a dumb money that follows in on some of their sort of crappier deals, the bottom drawer deals that they've got. But from a corporate point of view, being able to be quite targeted, say, this is where we add value. These are the people who are good in this sector. How do we find ways to work and network with them? Often it's a little bit of serendipity. You meet them at a GCVI summit or symposium or another event, or you just find ways to connect through a deal management software platform such as say Proseeder, and find ways to engage on certain entrepreneurs around theses. But it's really interesting when you look at this, how you think about working with the right people, how you meet them, how you can engage with them, and what value you can bring into that ecosystem. And this comes at an interesting time. Obviously, the past 10 years have really been up and to the right. We've seen more corporates do it. We've seen generally investments, what we call the golden age period, but up to 2016, 2017, where pretty well much if you backed any deals to substantial or followed on, you were likely to do pretty well out of it. Now we're starting to see the macroeconomic and other ecosystem really start to change. And that will put different pressures on the industry rather than having that sort of rising tide effectively lift pretty well much all boats sort of thing. As we come into the year of the water tiger in the Chinese Lunar New Year, we're starting to see, particularly in January, stock market falls start to affect some of the big tech giants. We started to see issues around the 1,000 or so unicorns, which are private companies worth at least $1 billion. There's now 1,000 of those, up from, relatively speaking, only a handful or so, 10 or so years ago. But if you look at the underlying economics of those, whether they're sort of unicorns or they've just IPO'd in the past couple of years, and you look at the actual, whether they're profitable or loss making, you know, the majority of these companies, whether listed post-unicorns or still private company, are effectively loss-making. What does that mean? It means that they're going to have to, at some point, unless they've got super large war chests, going to have to raise more money. And if the stock market's down, you know, if money is tighter because crossover investors, the big, you know, mutual funds or sovereign wealth funds or other investors, the hedge funds, start to think there's better value to be had in the public capital markets rather than back in some of these private, you know, unicorn type companies, then you might see down rounds, and that creates a negative spiral where it's harder to get the same amount of capital, harder to get the same very high valuations, and that puts pressure on these companies, which then causes potential write-downs, mark-to-market losses on a quarterly basis, which then means that CFOs and others are less likely to want to put capital into newer deals, or you have to reserve more to protect your established entrepreneurial companies. So that could quickly turn into a very negative spiral. So the stock market will be particularly interesting to watch over the next few quarters. And that a lot of that is being driven by liquidity. We are likely to see this supernormal or abnormal period over the past few years of record low interest rates and quantitative easing, pumping money into the ecosystem start to be withdrawn. Interest rates in the US are likely to go up from next month. It's likely to be that money will be withdrawn from the ecosystem to try and tackle inflation, which has obviously started to soar over the past year or so. And again, that will put pressure on stock and bond markets, create different opportunities, different risks. But this period, there hasn't been an interest rate rise in the US since 2018. This period for many corporates, bear in mind, half of those that have been doing deals in the past 2 years have never done a deal before. They have never seen an area or period or backed an entrepreneur in a more challenging economic environment. And so these entrepreneurs might be fantastic, and undoubtedly many of them will find a way through, but the valuations, the level of capital, and, you know, fundamentally the challenges that entrepreneurs will face will undoubtedly be harder for the rest of this decade than there have been. Doesn't mean that we will go back and, you know, the venture industry will retrench. The level of dry powder that VCs and corporates with committed capital have is unprecedented. So that will still encourage deal level, but whether it's at the same amounts and at the same valuation, I think it has to be questioned. And then one extra couple of thoughts there and sort of risks that are out there. Obviously, these record high valuations in private deals and also on the public capital markets for many of these loss-making companies, you know, has made it harder for even established companies to do some M&A. It's harder for a lot of the corporates to join in some of the very late growth stage rounds, and it's pushing them either earlier stage or into things like venture building and sort of incubators and accelerators. You know, incubators had a bad reputation maybe 20 odd years ago for being called incinerators because they were that efficient at burning cash rather than creating companies. You know, so all that indicates is that it's really hard to start an early stage business, whether you're building it yourself or whether it's outside. Now, corporates are going earlier stage in many ways because they've been forced to, just because of the, you know, abnormally high valuations, the amount of capital that has been available, which makes sense, but it's just to indicate that it's actually quite difficult to do it well. And if you don't have a track record or a unique thesis and ability to do this quite well, it will be hard. And again, one of the other factors that has started me challenge, I referenced Sebastian Malaby's new book, Power Law, came out, which is very good, actually, kind of good history and summary of the venture ecosystem industry. But he talks about venture as the third pillar of national power. You've got capital markets, you've got corporations, and venture capital driving entrepreneurialism and innovation, and ultimately economic and social issues. And so what that means is it starts to become much more strategic, not just for corporates to understand and do innovation well for their future growth. It becomes important to individuals, which is why we see a lot of people setting up new businesses as a way of trying to hopefully deliver value to themselves or go back to universities. We're also seeing governments increasingly work out and try and find ways to bring the VCs or corporate VCs into their region, support their local entrepreneurs, and how do they support industries of strategic or national importance. So whether it's the US or China, whether it's France and the UK and Australia, pretty much all countries now have a VC strategy, and they're trying to think about how do they protect their industries of national importance from obviously effectively industrial espionage, how do they support and nurture some of these entrepreneurial talents, and how do they bring the capital in. But that will make it effectively another headwind to think about the globalization. And corporations are almost all intuitively, instinctively multinational, and it creates different challenges as they try to navigate different portfolio companies. It's definitely one that we're mindful of for the next decade ahead. As I mentioned, we are seeing that actually out of these risks or different challenges, a number of opportunities that could be created. So it's very much a lens. How do you look at it? Different risks or challenges can bring opportunities if you're smart, if you have longevity, and if you think about creating the right syndicates, but ultimately support the right entrepreneurs. As we look through the the startup through the pandemic, if this is US Census Bureau data published on 12th of January, so kind of basically up until the end of last year. And what we find is effectively an abnormally high level of interest in people in the US to set up a new business. This is what are called business applications. The orange bits are those what are called high propensity applications. Effectively means they've already got the money, they've already set up a sort of the sort of framework to be able to do this, whereas the grey area, people would kind of put in an application that may or may not lead to a business. And so we're seeing a sort of record high interest in doing it. That ultimately means there's going to be a lot more startups that people will want to be venture backable. And so being able to look at that earlier stage, as I mentioned, almost all 96% of CVCs in our annual survey, which is published as part of the World of Corporate Venturing, so the World of Corporate Venturing kind of does two things. It looks at the data of what has been happening, and then it also does a survey which understands what people think the big issues are and how they're actually organized, and all of that information is fed in anonymized and fed in to understand what the direction travel in, how does that support the institute and the directory and the benchmarking GCV provides to ultimately hopefully share and disseminate the knowledge that people can use. But if you go back to the sort of the annual survey of the actual survey was more than 200 corporate venture capitalists, and each of those didn't necessarily answer each question. So if you look at the early stage, 96%, so effectively 130 of the CVCs, almost all of them, are interested in that A-B round, and then obviously some of them are interested in really early stage and some slightly later in terms of the growth stages. But fundamentally, that sweet spot of Series A-B, where there started to be some product market fit, some validation beyond just a minimum viable product, is really very much where corporates see a lot of the opportunities. And obviously, these entrepreneurs aren't just in the US, although that's the biggest market for CVCs to invest in, with more than 2,000 deals last year. But actually, corporates are active in pretty much every country around the world. We just had, we worked with the one of the big European development banks, and they brought in some clients from Eastern Europe and Central Asia and the Middle East. And one of them from Uzbekistan had just done the first venture deal in that country, which is in Central Asia. So what we're starting to see is pretty well much everywhere around the world, but particularly driven by the UK, Japan, China, India, and the US, are really the homes for where corporates think there's a lot of value to be driven, and are, and as part of that sort of globalization of venture, which according to the Economist chart on the left-hand side, nearly reached 600 billion in total, of which corporates were involved in effectively half, of about 300 billion. And so expectations, I suppose this goes back to one of the key questions, which is, despite the risks, despite issues around inflation and other issues, the corporates that responded to the survey effectively expected to put as much money into venture going forward this year and beyond, at least the same or more than what they have been doing. And that was about 90% of the respondents were that way. So it's clear that unless something big and macro happens that really throws expectations off, corporates want to be part of the innovation ecosystem going forward, and are prepared to put at least the same amount of money as they had done. And bear in mind, 2018, 2019 were record years at the time, and increasingly so last year, of course. And so why are they doing this? What are the CVC priorities? Again, looking at the GCV annual survey, what we find is that they're looking at it particularly interested in a number of issues. Obviously, they want to balance financial returns with preparing for disruption, either creating new businesses for the parent company, supporting existing businesses, or looking for disruptive threats and opportunities that there might be at the back. And it's fairly evenly split. And actually, most of the corporates could answer more than one and say, we're actually interested in more than one of these issues. We're trying to get that blend between financial and strategic. It's not financial or strategic. And I think that's a substantial shift over the past 10 years. 20 years ago, it was very much financially focused. 10 years ago, coming out of the global financial crisis, a lot of them were particularly thinking about strategic issues and digitalization. Now they're saying, we think we can get the best of both. We think we can get great financial returns and we can get strategic insights. And that's really important. And how are they being organizing themselves? How are they setting up? Again, there's a huge amount more within the sort of 120 plus pages of the World of Corporate Venturing, which covers all areas of how corporates are organized, what they're thinking, how they hire people, and then obviously what are they doing in terms of sectors, stages, regions, and everything else that you can think of. But if you think about what they're trying to do and how they're organized, are they set up with a balance sheet, so an annual commitment year on year, but with a dedicated unit, which is trying to deliver on so business unit priorities, but they're also trying to think about theses where the business unit support is not required. This basically gives them more flexibility to find things that might be a little further afield beyond the sort of usually 1 to 2 years, if that a lot of business unit executives worry about. And again, we're seeing an increase and rise in numbers of what we call independent affiliates. This might be a separate legal entity with fully committed capital, so effectively more like an LP-GP structure, but the fund remains subject to significant corporate parent control and engagement, which can be really important to add the value back to the portfolio companies, and again, drive that longer term partnership between them. And again, the separate legal entity with fully committed capital with the autonomy. This is the sort of more traditional VC, where in effect the limited partner is a corporate or corporate one among many. And then bottom we see the sort of corporate balance sheet without a dedicated unit. Basically, they're doing deal by deals. And I think, again, this is slightly skewed by the sort of respondents. Those who are more likely to respond to the survey will be those with a dedicated CVC unit. And I think the issue for many of the sort of near 2,000 or so corporates that have been doing deal since the pandemic struck that we talked about earlier, what we're seeing is many of those don't necessarily have a dedicated CVC unit. They are the ones doing deals on an ad hoc basis, and getting those to convert to being much more professionally run, with established team, with committed capital, or at least a strong commitment from the executives to do annual budgets, I think will be important to drive that sort of transition from relative amateurism to relative professionalism. Again, if you think about that sort of combination, it's not financial or strategic, it's financial and strategic. Obviously, the sort of bare minimum is to have, the ability not to lose money, and then try and deliver sort of more venture-like returns, which is the majority of those who answer the survey, a little more than a third. Relatively few, less than 10%, have no financial performance targets, which I think is important. It's not just important to set KPIs about what you want to deliver strategically, but it's also important to say we actually value the capital. We have a cost to capital, increasingly so as the abnormal levels of quantitative easing start to get withdrawn and interest rates rise, that will put a bar, which always historically was about 8% to 10% in terms of return needed to justify the cost of capital being put out. So very much having that sort of, that sort of more almost venture-like returns will be significantly important, but the hurdle will probably end up, depending on how inflation interest rates end up, going back closer towards that 8% hurdle than historically, if the cost of equity or the cost of capital is effectively zero because you can borrow so easily, and then inflation has been minimal, then you don't really have to do much more than return the money that you put out. But actually, if inflation and interest rates go up, then their cost of capital will follow as well. And then the value drivers. What is it that corporates are bringing to their entrepreneurs? I referenced it before. She's really looking for capital, but she also wants the things that will drive her business: the customers, the product development, the sort of being able to hire the right people, particularly around the great resignation that's increasingly an issue, and then eventually at some point an exit, whether it's an M&A or an IPO. And corporates are particularly able to help on all of those points. Why do they do it? What are the things that they want to try and get out of it themselves? They want strategic insights. They want to understand what the entrepreneurs are doing that might indicate where emerging technologies or markets or businesses are. That's obviously the most important issue from their point of view. From a commercial engagement, there might be some sort of parent partner portfolio or innovation partner in that sort of business development. It's a general rule of thumb for each sort of investment director you might have finding the deals. You need probably 4 or 5 people who can do the business development to support those portfolio companies to land the value internally. And then the access and optionality: are you creating new businesses, or are you finding potential M&A targets? And then things like culture change: are you able to, through corporate venture, become that wider innovation catalyst, and help the overall parent company become a little bit more robust? And then the brand enhancement through CVC: are you able to attract talent because you're able to say to yourself, we want to be dynamic, we want to be one of the companies that survive rather than a company that fails and struggles. And I referenced it before. When you think about the index, the best CVCs score highly across these metrics: for financial, strategic, in terms of investments and exits, whether it's the SoftBank and Fidelity's and Alphabet's, i.e. Google of the world, through to Tencent and Salesforce, or newer entrants, groups like Coinbase, which is a sort of Web3 or crypto company, only really been doing venture investing for the past couple of years, but have built up a very large portfolio with phenomenal returns in a relatively short space of time. We're delighted to have Coinbase join after this webinar, a private invite-only roundtable for the Global Finance Council within Global Corporate Venture. We do a number of sessions and councils looking across different sectors as well as different regions, as well as the Global Energy Council and Global Healthcare Councils. We have the sort of Global AI Council, setting up the Global Industry Council, and basically to cover the main parts of the economy. And the Global Finance Council, which is chaired by Jacqueline at Munich Re and Jaidev Chegor over at Capital One Growth Ventures, is pulling together discussion looking at DeFi, or decentralized finance. Delighted to have Coinbase alongside Digital Currency Group and a host of others joined that invite-only session, which follows on from the sector report, the quarterly report that came out looking at DeFi last week. So, and then as we come towards the conclusion, we'll see if we've got some questions in Q&A, mindful of people's time. There's a couple of things that I found particularly insightful compared to the overall venture industry the sort of male-female balance or ratio within corporate venture capital is much higher. Obviously still majority male, but in terms of relatively even or majority female is nearly 40% or so, or 40% when you add in the all-female teams. And if you compare that for the prior sort of 50 years from 1970 to basically 2020, research out of Wharton and Harvard were looking at VCs, and the percentage of female partners doing deals stayed steady, went up by about 2 percentage points from about 7 to 9 percentage points. So the fact that it's even 40% or relatively even is substantially higher than the overall industry, and I think that's partly driven because corporates with their HR teams are particularly mindful of issues around of diversity and equality, but also because I think corporates realise that some of the best ideas come from thinking outside the box, and if your team looks like people that they back, you're ultimately swimming in a relatively narrow pool in that. And again, if you think about it from diverse ethnicity, so i.e. from people from outside the predominant ethnicity of the country where they're based, again, it's relatively positive compared to the sort of the general venture ecosystem. Obviously could still be improved depending on how you look at them. So that sort of includes the sort of the main highlights from the sort of world of corporate venturing and annual survey. My thanks again particularly to Kalyan and Raksha for doing so much of the hard work on it. Thank you to you all for sharing so much on the survey highlights. In quick summary, it was a record year. But there are a number of challenges to become more professional, to fight off competition, use the right networks to support the entrepreneurs. And now is the time effectively to step into those challenges and opportunities and deliver on your aims, or fundamentally risk decline and obsolescence. A couple of quick sort of mentions for those that want to sort of develop their network further. As I say, we've got the GCV Symposium again. This will be our 11th annual conference, which will be May 18th and 19th. With a gala dinner, black tie dinner at St. Paul's Cathedral. We've got the GCVI Summit, which pre-pandemic was about 800-900 attendees, about $10 trillion of aggregate annual revenue from the corporates who attend, and maybe 200 billion of venture assets under management. Delighted that be June 22nd, 23rd, which will include some conference speeches from some of the top VCs as well. Sequoia is this year's sort of highlight. Prior years, we've obviously have Vinod Khosla, Scott Sandell from NEA, managing partner of NEA, Scott Cooper, managing partner of Andreessen Horowitz, among others. And then later in the year, we'll do a sort of VIP leadership exchange for members of the GCV Leadership Society to have a sort of a more exclusive gathering, also in California. In October, we'll do the Corporate Venture in Brazil conference with the government there for the Latin American region. And then our GCV Asia Congress will be in Tokyo, expected around November, but obviously subject to travel restrictions and other restrictions. And then we're going back, obviously, hopefully, as we come out of the pandemic and Omicron as a variant, we'll go back to a number of smaller, more focused roundtables and discussions in regions, whether in the UK, we'll have a CVC drinks on 27th of March. In the DACH region, we'll do a number of city sort of dinners and sort of conversations, particularly in Munich. And then we'll do other road shows in the US and elsewhere in the continent in Europe. So thank you for those who will be able to join those events. Quick mention that tomorrow we'll have another webinar. This is the annual awards for the GCV Rising Stars and Emerging Leaders, effectively those with less than 5 years experience and those with more than 5 years experience who aren't top of the units, which are powerless people. Those Rising Stars Emerging Leaders will be celebrated tomorrow when we announce the winners, and then they'll meet up just before the GCVI Summit in June at the Monterey Aquarium for a dinner. So don't miss it and register now for that tomorrow's awards. My thanks again to Kalyan for preparing the data from the world of corporate venturing that was used and seen in these slides. Obviously, you can reach out to any of us at the team. Happy to help if you've got particular questions. And that is the end of the show. So I'll now sort of, in the final 5 minutes or so, we'll have a quick look at questions. As we go through that, we've got Someone's asked about the trophies behind me. I'm chairman of a cricket club, and so out of sympathy, I think they gave me a trophy, but I also play cricket, so there's a couple of those as well from last season. 6252 investors, does that mean CVC units or professionals? That means effectively corporations that did the deal. Some of them have established units and some of them just did it more ad hoc. There's about 25,000 or so CVC professionals that we track at Global Corporate Venturing among those teams. Copy of presentation, I'm sure it will be available afterwards. The session's been recorded, so thank you for that. And then we'll move over to the Q&A. Thanks to those who've sent notice. Question coming in from Martin Hemming. How would you describe the largest 2 to 3 difference between US versus European corporate venturing? Yeah, good question. I think one of the things we find quite interesting is the US corporates are able and particularly keen to support US portfolio companies, whereas we often find a lot of the European corporate venturing units are investing more in the US or places like China. Then you will see we actually do a sort of flow chart of where the money goes both inwards, externally. Martin presents this data at the GCV symposium in May. He'll be talking a little bit between difference between China and the US and Europe. So good question there, Martin. And actually, I'll wait to see what your answer is in May on that one. Lucas from B Tomorrow says, any insights as to why almost 50 corporates closed down the CVCs? Yeah, often it's management change. That's the number one. There's a sort of tall poppy syndrome that can come in. People come in and say, this unit's doing well, they've got bonuses, maybe it's more than other peers, there's a bit of jealousy, there's issues around people wanting to have the unit more under their control, and it forces people out and teams to leave. Right, how the CVCs expect the SPACs to pan out in 2022, 2023, does it differ? I think SPACs are a bit of a bust of flush. Obviously, a huge amount's been raised in the IPOs. Now they've got a de-SPAC by finding acquisition targets. I think a number of those will struggle to get through. Personally, Kellyanne did a great article back end of last year, basically calling out a lot of those issues. Obviously, fantastic for the entrepreneurs and the CVCs that were able to get these de-SPACs onto their portfolio companies. I mean, a group like Total, I think, had 6 exits last year. Most of them were acquired by SPAC type companies. Fantastic performance. I think, just out of memory, if I look at a company like Hessen Motors, I think they invested back end of 2020 at a 200 million pre-money valuation. 4 months later, they were in effect SPAC'd out at a 2 billion valuation. So 10-fold increase in 4 months with no real change in the fundamentals. So that whole SPAC thing is definitely a challenge. Slide deck available. Biggest mistake corporates make when dealing with startups. Yeah, not really being aligned. I think if the corporate kind of gives too much pressure onto the entrepreneurs, or they put too many terms in, they're just generally not finding the best entrepreneurs. I think there's so much out there. So there's a whole. So I think the biggest mistake is not trying to align incentives in alignment with the startups for the corporates, and then you end up fundamentally usually with more mediocre entrepreneurs. Chris asks, interested in data and trends split between CVC direct and LP? Yeah, I think we track a few hundred corporate LP relationships each year. A lot of corporates do LP commitments into VC funds, particularly if it's going into new geographies or new sectors that they aren't necessarily resourced up to tackle, and more around new corporates wanting to learn best practices, from the VCs, build some relationships. That tends to be a lot of those. So I think we could see a lot more LP commitments this year as some corporates realize that ad hoc deals aren't necessarily a good way to go. They kind of reset themselves, go back to basics, try and learn through the GCV Institute or LP commitments, some best practices. And then final minutes, great data from Julio. If you're on the stat that more than 60% of senior executives do not understand norms of venture capital, how much of an issue is this? An impact on role of CVC? Yeah, it's a huge one. I mean, basically, if you can't, you know, if you've only got one champion within your corporate parent and the rest of the business units or executives don't understand CVC, you're just waiting to be crushed. You know, the Corporate Venture and Survivor Guide book, which formed the basis of the Institute, very much has this maturation cycle. What do you need to do to get started? That 0 to 3 year period, the 4 to 6, and then into the resilience phase, 7 to 9 year period. There's different sort of issues at each of those stages. But fundamentally, if you've got a very narrow base of understanding, you know, or they're not setting up for the right reasons, you know, you're just waiting to be, you know, to be culled fundamentally. So it is a big, significant issue. Getting management up to speed and understanding the benchmark will be core to longevity. You might find the best entrepreneurs, but if you get killed, those entrepreneurs will go off and you get washed away. So thanks, really, great question. Thank you to you all for the great questions. Thank you so much for everyone for being able to join. Delighted to see so many on. This will be shared afterwards, but obviously do take a look at the World of Corporate Venturing, because this was only an hour-long snapshot, but there's a good few hours that you can have fun in on that. But thanks once again, and see you again tomorrow. Bye-bye.